Let's move on to issuing bonds payable at a premium. In this example, Smart Touch Learning is issuing 9% 5-year bonds when the market rate is 8%. So our bonds pay more interest than our competitors' bonds will. And we know this, so we're going to charge people that want to buy these bonds extra because they're going to get more interest over time. Well, we've gone and we've looked up on an index what the going bond price is for 9% bonds in this 8% market, and it's 104.10, which means we can charge 104.10% of face value of these bonds when we issue them. Therefore, we're going to receive $104,100 in cash, again found by taking face value and multiplying it by the bond price. So we're receiving cash of $104,100. We put that on the books with a debit to cash. Well, we know that bonds payable, the actual liability, has to always go on at face. So we credit bonds payable for $100,000. And because we would need a $4,100 credit to make our debits equal our credits, that has to be the amount that we put into premium on bonds payable, which makes sense because we're charging $104,100 for $100,000 bonds. We're charging an extra $4,100. That is our premium. Premium on bonds payable is called an adjunct account. And what an adjunct account is, it's an account tied to another account which actually increases its value. So bonds payable goes on the books for face and stays there for the entire life of the bond. At the time we issued these, we made a $4,100 credit to premium on bonds payable. That is the balance of that account. So when we display our bonds on the liability section of our balance sheet, we list our bonds payable at their face value of $100,000 and add our premium of $4,100 to arrive at our carrying value of $104,100. Just like we had to take the discount off the books by the end of the bond's life, you have to remove all premiums from the books over the life of the bond as well. So our beginning premium was $4,100. These are 5-year bonds that pay interest semi-annual, which means in total they're going to make 10 interest payments over the bond's life. And if we're using straight line amortization, we should remove an equal portion each period. So if we take $4,100 and divide it by 10 or multiply it by 1/10, whatever you wish, you're going to come up with $410. To remove this evenly over the entire series of 10 payments we're going to make on this bond, we should amortize $410 of that premium each time. So we'll start with interest expense. When you are amortizing a premium, you have to subtract the amount of amortization from the actual cash payment of interest you have when recording your interest expense. Our cash payment on these bonds is going to be $4,500. Again, you find the amount of interest you're actually paying by taking face times rate times time. 100,000 times 0.09 times 6/12 is $4,500, but we are amortizing $410 worth of premium. So the difference between those two numbers is $4,090. That is the amount that we debit to interest expense. When we put our premium on the books in the first place, we credited it because it's an adjunct liability account. It increases the value of a liability. Therefore, it works just like a liability. It goes up on the credit side. Well, now we need it to go down. So we're going to decrease this premium on bonds payable by the $410 we just determined by debiting that account. And then lastly, we're going to record the actual payment of interest, which we just computed to be $4,500 by crediting cash for $4,500. And after 2 payments of interest and therefore 2 amortizations of our premium, what would this look like on our books? Well, we have bonds payable, which is going to stay on our books for its entire life at its face value of $100,000. Our premium on bonds payable account started with a balance of $4,100, but we know that we are amortizing it by $410 each and every time that we pay interest. So after 2 payments at the end of the year, we would have amortized it by a total of $820, reducing its balance down to $3,280. And on our balance sheet, when we would report this at the end of the next year, when we made 2 more payments of interest, we would have a reported amount of bonds payable of its face value of $100,000 plus its premium on bonds payable, which would now have a book balance of $3,280, for a total carrying value of $103,280 for the bond. In looking at the amortization schedule for a bond issued at a premium, it's the same exact concept that we had before, with one big distinction. When you're trying to figure out what your new carrying amount of a bond is going to be after an interest payment, you subtract the amount that your premium was amortized by. So if we started with our bonds on the books at a carrying value of $104,100 and we amortize $410 worth of premium, it's going to reduce its balance down to $103,690. It's not going to change the amount of cash that's paid. That's still always found by taking face times rate times time. It's going to be $4,500 for these bonds. And it's not going to change the amount of interest expense we're recognizing for a bond issued at a premium. That's always the difference between the actual amount of cash you're paying and the amount you're amortizing, in this case $4,090. Those are going to stay the same the whole way through. The only thing that's going to change on your amortization schedule is your carrying amount, because each and every time you're going to subtract another $410 from your carrying amount until you get to the end of the bond's life on December 31st, 2022, when it will be carried on your books at its face value of $100,000. So let's do another example here. On this one, on January 1st, Paradise Pets is going to issue $30,000 worth of 10% 5-year bonds payable, and they're going to do so at a bond price of $105. Well, we're selling these bonds for greater than their face value, so we're receiving even more than $30,000 in cash. How much? Well, we find that by taking face value and multiplying it by bond price. Again, remembering that bond price is always expressed as a percentage, so you need to convert it to a decimal when you're calculating. In this case, it would be 30,000 times 1.05, and 30,000 times 1.05, or 105% of 30,000 is $31,500. That's how much cash we were receiving. Well, that's more than the face value of these bonds, which means we are issuing them at a premium. So we need to put premium on bonds payable on the books with a credit for the amount that is the difference between the cash that we are receiving at issuance and the face value of the bond. We are receiving $31,500 in cash for issuing bonds with a face value of $30,000. We have a premium of $1,500. And then lastly, bonds payable, saying one more time, always goes on the books at face value at the time of issuance. So we need to lastly credit bonds payable for that $30,000 in the journal entry to record the issuance of bonds payable at a premium. Next up, on June 30th, Paradise Pets is going to make its very first semi-annual interest payment on these $30,000 worth of 10% 5-year bonds. And when they do so, since they're issued a premium, they have to amortize a portion of that premium as well, which they're going to do using that straight line method. So how much do we have to pay in actual interest? How much cash do we have to transfer to our bondholders as an interest payment? Well, if we take face times rate times time, 30,000 times 0.10 times 6 out of 12, because it's semi-annual, we come up with $1,500 is how much we are going to hand over in actual interest. And we need to amortize our premium using the straight line method by an equal portion every payment that we make over the bond's life to figure out, how much we have to take away each time to reduce it to zero at the end of the bond's life. Well, our premium started at $1,500. And this is a 5-year bond that pays interest twice a year. So that's 10 total payments. If we take away 1/10 of that premium each time, it will be reduced to zero at the end of the bond's life. And 1/10 of $1,500 is $150. So in our journal entry, we start by debiting interest expense. And we're going to debit interest expense for the difference between the amount of interest we're paying in the form of cash and the amount of premium we are amortizing. $1,500 minus $150 is $1,350. Next, we remove that premium from our books, or at least a portion of it, which we just determined is going to be $150. And we're going to do that by debiting premium on bonds payable for that amount. And then we record the amount of cash we are actually transferring for our interest payment to our bond holders, which we just determined is $1,500. And in total, we paid semi-annual interest and amortized the premium on these bonds payable.